Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Hey, Victor, welcome to the show.
Great to be here.
Man, I'm excited to have you on as a guest. Certainly appreciate you taking the time out of your, I'm sure, very busy schedule to share with us your insights, not just into the real estate market, but also to what you invest in and how you grew your company. So if you can give us just an overview of, the same questions I always ask everyone who comes on. Where did you start? Where are you now? And how did you get there?
Well, my path into real estate investing and developing was not the traditional career path by any means. I started out my career as a microprocessor designer, electrical engineer, rose through the ranks of both public and private technology companies. I've got microprocessors designed into all kinds of different applications for about a decade. 52% of the phone calls in North America were routed by a processor that I designed. I've got chips in the Patriot missile, in Canon and Panasonic printers, in the seat back displays on most Airbus aircraft. So if you watch the movies on any airline, you've probably been routed by my processor. All kinds of different applications. Pachinko Pachi slot machines in Japan in partnership with NVIDIA and Sammy Sega. The list goes on and on, hundreds and hundreds of applications. So that was my entree into this world. And about 2009, I was traveling back and forth to Tokyo every couple of weeks. We were building a new cellular network in Japan for the number 4 carrier in Japan called Wilcom. And it was burning me out physically, emotionally. That 13-hour trip to Narita Airport every few days was pretty punishing. And so I decided at that point to resign my position as VP of Engineering and take a hard left turn into the world of investing on a full-time basis.
Wow. One, that's amazing. So you must be really, really proud of the fact that, you can get on an airplane and be like, oh yeah, that's my microprocessor that I developed or chip I developed. And here I am using it. That probably was slightly fun.
Yes.
But how did you pick to make that left-hand turn, as you call it, into real estate?
I looked at other technology ventures, and in particular in hardware design. When you're designing new chips, the cost is high. If I told you as an investor that the minimum investment to get anything done in that segment is $50 million, and maybe in 4 years or 5 years, I'll make your money back, and maybe year 6, I'll give you a profit, are you lining up for that investment?
Probably not.
Probably not. And unfortunately, that is the reality of that business. Unless you have the volumes of an Apple or a Samsung, where you're going to be having a high run rate in the consumer electronics space of several million units a month. I got a chip designed into plasma TVs with LG, and it was supposedly a research project, and their chip failed, so they ended up taking our design into production. We were running 250,000 units a month. Unless you can get those kind of volumes, it's really, really hard to make a go of it in that business. So I started looking further afield. What other industries were there? What other segments were there where people will invest with you? Is there opportunity to do something of significance? It's not a monopoly or a duopoly where you've only got a handful of deep-pocketed players. And real estate kept coming up over and over again as a very solid place to play. And people will lend you money, so you can scale. You just have to do a good job, and that was really what drove the decision.
Gotcha. So you said, "Hey, I want to get out of what I'm doing now. It's running me ragged. I want to make a left turn into real estate." What was your first step?
I live in Ottawa, Canada, which is our nation's capital. We have a regular flow of government contractors, embassy staff, parliamentary staff that are coming through the downtown core on a medium-term basis. This was before the days of Airbnb, and a 12-month unfurnished lease was useless to them. Their housing allowance wouldn't cover a suite hotel. So there was demand for a furnished executive rental in the downtown core within walking distance of Parliament that would meet that price for their housing allowance. So I figured out what that was. Okay, so the number was $1,800. What could I deliver for that number that would give me a good profit margin? So I took a very business approach to it. I'm not a real estate guy. I'm more of a business guy. And I just look at those supply-demand metrics and just started buying up one-bedroom condos within 4 blocks of Parliament. And we were always full. It was a good business. It wasn't a great business, but it was a good business. It was very solid, very stable. And I actually started that back in 2006 while I was still in my technology job, and just wanted to continue that further. From there, saw the opportunity happening south of the border in the U.S. We, of course, had a bit of a financial crisis in Canada, but nowhere near what was happening in the U.S. So I saw the opportunity in the U.S. as kind of the opportunity of a lifetime to buy things far below construction cost. And so I sold that portfolio bit by bit and repurposed the capital south of the border. Started doing fix and flips in the Chicago market, in Philadelphia, in Florida. Ended up wasting a lot of time with some bad partners. So at the end of my venture in Chicago, it was like, well, damn, that was a waste of a couple of years and a bunch of money, and I won't do that again. Not that there was anything wrong with the Chicago market per se, but a good deal with the wrong partners will screw it up every single time.
And those are high touch types of real estate transactions.
Absolutely. Absolutely. I had to relearn what I had learned in the tech industry. In tech, I had raised a lot of capital, had done 4 or 5 corporate buyouts. So I learned how to raise money, taken a lot of things from concept to realization. So convince people to invest based on just an idea, not even proven. So if you can do that in something as speculative as tech, doing it in something as nuts and bolts and bricks and mortar as real estate, by contrast, is much, much easier. So I had to relearn that process. Like most people, it's a game of big numbers. I started with my own capital, ran out fairly quickly, and then hit that ceiling where I said, all right, now what do I do? And then I remembered, oh yeah, Victor, you know how to raise money. So, and I relearned the process, and in the process discovered that it was virtually the same process. And when raising money was easy, it's because there were a certain set of ingredients that were in place. And when it was difficult, it's because one or more of those elements were missing. And in fact, in the last several years, it drove me to write a book. I wrote the book Magnetic Capital from the perspective of a practitioner, that it's that process that when those elements are in place, raising money is remarkably easy. And when one or more of those elements are missing, man, it gets tough.
That's interesting. And just a plug for your book, a shameless plug for it. Where can we find that?
You can order it on Amazon. So it's called Magnetic Capital. And it's written from the perspective of a practitioner, someone who's doing this day in, day out, every day. Most of the works out there are pretty academic, or they're focused on some other angle, like maybe how to raise money for charities or how to raise money for technology ventures. And having done it in a few different ways in a few different ecosystems, I've discovered that it's remarkably the same.
Gotcha. Yeah. If you're listening to this and having trouble raising capital, go find that book, because Victor, you clearly have seen this from both sides, and especially coming from the tech side, where, like you said, when you're selling highly speculative investments, call it selling, I guess, versus investing in something much more predictable, such as real estate. Certainly you've learned some things along the way. So you're somebody we should be listening to. When it comes to the investments that you had then in Chicago, fix and flips, things like that, what did you move into next?
We got into business in Philadelphia and started out, uncovered a couple of potential partners down there who looked like they were doing some good work. But they were doing it all themselves with their own capital, building it up fairly organically. And the conversation, I saw the opportunity in the marketplace and said, well, if you had access to more capital, you could really scale this up. Of course, you would have to share some of the profits, but you'd more than make it up on volume. So our very first project, we went out to the Philadelphia Housing Authority to their auction They were auctioning, 400 properties on one day in 66 package lots. And we ended up buying 15 properties as part of that auction in one day for $350,000.
Wow.
So that was our first foray into the Philadelphia market together as a partnership. And these properties some of them were highly distressed. So we really treated them very much like a new construction project. In some cases, we would, fully gut the building. We would maintain the brick exterior, the brick facade, or the structure, but we would basically put a new building on the inside. So that got us into the realm of construction. Now, and kind of one step at a time. We said, all right, the step from there to ground up construction, infill construction, is a small step. So we started looking at vacant properties. Part of that package of 15 properties included some vacant land. We ended up buying, at least 85, maybe 90 properties within about a 10-block radius. So we were often buying properties that were zoned multifamily, building by right. In some cases, we would push the envelope on density and go to the zoning board of appeal, get a little bit more density, make the numbers a little bit sweeter. And we just got into the realm of new construction, and whatever we could build based on the land we were able to assemble. If we got 3 properties together, that might be a 9-unit. We built a 13-unit building. We built an 11-unit building, whatever the density would allow us to do. So we just started developing this process of repeatedly building these small to medium-size apartment buildings within a very narrow radius, so that we could effectively manage them as if they were a single multifamily building. The good news was we were generating our own comps.
Right.
And not only that, we were using a strategy that I call buy on the line, move the line. So what is that line? That line, and it exists in every city in America, is that on one side of the line, you've got this hot gentrified neighborhood. You've got the Starbucks on the corner. You've got the art gallery. You go 2 blocks too far and you're in the hood. Mm-hmm. Wherever your listeners are sitting, you can imagine that line. Every city has it. Now, if that line is a hard boundary, maybe a municipal boundary, a school district, a freeway, a railway line, those lines are a little bit more difficult to move. But if it's an arbitrary line, as it often is, that line is movable. Now, if you just do 1 or 2, the marketplace doesn't care. But if you do 5 or 10 and put a little bit of scale behind it, all of a sudden the marketplace says, oh, the line has moved. And now you're starting to get the valuations from the hot neighborhood next door, even though you bought the land for pennies on the dollar. And that's where you get some massive value creation. Basically playing a large developer's game on a small scale. And when we would go for an appraisal, we would go to get these properties appraised for a takeout refinance, and we would come within 1 or 2% of our target on the appraisal. And that's because we knew our numbers. We were setting our own comps. When they were asking for rents in the area, we weren't going to Rentometer. We were giving them our own rent rolls because we were just a few doors down.
That's fantastic. That's fantastic. And is that the model that that you're still working off of then?
We've gone beyond that. We're doing ground up construction now, a lot of greenfield projects. We've got projects in multiple cities across the nation. We are also assisting some developers on a consulting basis. A lot of folks that get into this business don't have the full complement of skills. So we now have engineers on our team. We're doing multi-100 unit new construction projects, ground up, greenfield. We've got an 80-bed assisted living project under construction right now. We're in the entitlement phase on a 120-unit mid-rise condo building, a nine-story condo building. We've got some industrial projects. What else? A residential subdivision for 64 townhouses, boat and RV storage, all kinds of different projects. So we are firmly today in the realm of new construction, new development. We love buying land at a good price, getting it entitled, creating the value that way, and building. We're really community builders at this stage. We love building communities that people feel compelled to call home.
That's fantastic. I mean, again, you've done so much. What would be some of the keys, I guess, that you've learned in this? I mean, obviously, you guys you're investing across a variety of assets.
Yes.
So, what are some of the keys that you've learned along the way as you've scaled? What are some things that we could take home and say, yeah, that's a great point. I want to, repeat what Victor has done.
I think a lot of people take the approach of coming at it from a scarcity perspective. They look in their bank account. They say, okay, I've got $100,000 in my account. That defines the scope of what I can do. Just one person in my team, that defines the scope of what I can do. And if you try and grow organically from that perspective and say, okay, I'm going to grow from 1 to 2 to 3 and so on, what you find is you get stuck in a low Earth orbit that you never escape. You never get escape velocity. On the other hand, if you say, all right, in order to get a project off the ground, I need a breadth of skills. Maybe that's 4 or 5, 6 people. Then get those right people in your team and go after those larger projects. The biggest mistake you can make is to try and be too small, because then you can't afford the skills that you need to do anything that's real.
That's fantastic.
If you aim higher, that's the key. Now, it often creates a paradox because the entrepreneur is saying to themselves, how can I feed 7 families when I haven't figured out how to feed my own family yet? And it's this paradox. You're stuck. Well, all you need to do is you need to find those couple of key projects that'll get you to get that breakout. So you may have to put in a bit of sweat equity at the beginning, but I'll give you a simple example. As part of our projects, we always charge a developer fee. Now, that's not greed. It's not that we're getting rich off of developer fees. It's fiduciary responsibility to our investors. Imagine if one of the key principals got sick. Where would the money come from to hire someone to step into that person's shoes to complete the project? If you haven't got that funded, you're not taking care of your investors. So you have to fund those positions. It's basic keep the lights on type of funding. And so, for example, if I'm building, a 240 unit apartment project, my developer fee, our developer fee, it's not my fee, it's our fee, is 4% of the hard construction cost. It's similar to what the general contractor's fee would be. So on a $40 million project where the hard construction is 27, 28 million, the developer fee is, what is that, $1.1 million, $1.2 million? Do you think I can hire some talent for $1.1 million? Absolutely.
Sure.
Not using that money to line my pocket, it's to get the project done, but also to build sustainability into the organization. Could I do that with a single family home that I bought for $50,000 on the south side of Detroit? Of course not.
That's fantastic, Victor. This could go on for a long time. You clearly have done a lot, and I want to do part 2 of this because I really feel like you've got a lot to share. Let's jump into the final 4 if we can, because we're out of time. And I think you may have already said it, but we'll go through them anyway, because your answer may be some different new nugget. The first question is, if you had to take everything you know and distill it down to one piece of advice for an aspiring investor, what would that one piece of advice be?
Get the best people on your team. They will not cost you money. They will make you money. That is the only differentiator. Get the best quality people on your team, nothing else.
Wonderful. And what's one thing you're doing right now to stay on top of your game?
We're focused very much on improvement, on process improvement. We have a daily stand-up meeting every morning with the entire team where we look at where we're doing well, where we're not. That's vitally important just to stay very well connected. We are also looking at how we can empower people to move independently from each other so that we get more benefit from having scaled the team. So those are probably the couple of things that we're doing on a daily basis.
When it comes to giving back, what's one way you're making the world a better place?
Well, I have a daily podcast 7 days a week. I'm the host of the Real Estate Espresso podcast, and we've got a very loyal listener base. So definitely want to check that out. We're on all kinds of different platforms. Wherever you listen to podcasts, I'm sure you're going to find the Real Estate Espresso podcast. It's a short form podcast, 5 minutes on the weekdays, just me. And on the weekends, we have interviews with notable people from the world of real estate investing. So 7 days a week. It's spelled like the Italian coffee, ESPRESSO, espresso. And it's your morning shot of what's new in investing.
That's fantastic. And it sounds like you just gave us how our listeners can get in touch with you via your podcast and any other ways they can get in touch with you.
Connect with me directly through my website at victorjm.com. That's victorjm.com.
Wonderful. Victor, thanks so much for your time today. Certainly appreciate it and look forward to doing this again sometime soon.
Right on. Thanks so much, Sam.
Thank you.